Donald Trump is pushing major credit changes in 2026, starting in this week in February, and most people have no idea how this is going to impact them. And to be very clear, this is not political. I don't care if you love Trump, you hate him, or if you're somewhere in between. We're simply going to break down the changes and how the credit system actually works, who benefits when all these rules change, and most importantly, who's going to be quietly pushed out. Because starting this week, there are 3 major changes that are happening. 2 of them sound really good on the surface, which everyone is talking about, but one of them could lock millions of people out of their credit forever. And to make it easy to follow, I'm going to break them down in reverse order, starting with the one that everyone is arguing about, moving down into the one that no one is talking about, but they absolutely should be. And while you're watching the video, I do want you to focus on one specific question, which is who's actually getting benefits from all of these changes? Is it the banks? Is it the people? And what you would change, if anything, if you were the one in charge. Starting off with change number 3, which is Donald Trump's proposed 10% credit card interest rate cap. So Donald Trump has publicly called for a 10% cap on interest rates for a certain amount of time. And we all know this sounds great on paper, but how does it actually look to the banks? Who does it really affect, and much more? So let's take a deeper look. Because we all heard the term, there is no free lunches. Someone's going to pay, whether it be the consumer, bank, or somewhere in between. And for illustrative purposes, we could assume that most credit cards right now are anywhere from 20 to 30%, depending if you have a card through your local credit union or a traditional big bank. So technically, reducing them to 10% for the time being would, yes, it would be a big break for most people, but what would it look like on the internal side? Rule number 1 is that banks don't technically absorb losses, they just move the actual risk. So when we go to apply for a credit card, technically they're just evaluating the risk and they're selling you based on the risk profile, whether you have bad credit, if you have good credit, if you make a little bit of money, or you make a lot of bit of money, depending on where you live, family size, so on and so forth. But if banks are forced to reduce the interest rate to 10%, and it would help out consumers like us, on their end, they have to obviously subsidize the risk somehow, whether it be lowering your credit limit, whether it be making it harder to get approved for credit, which we've heard a lot about in the recent news, and much more. So the real question here is not that if 10% is good and if it would help people out, we all know it would help people out, but what is the actual opportunity cost of reducing to 10% interest? And this is all assuming if banks actually want to play nice in the sandbox and really comply with the 10% orders, because as we've seen in recent news, or may have you not seen, so I'll share it here behind me, most of them are giving a lot of pushback and they're not really willing to comply with the strict 10% orders. And for the ones that do, maybe they're only going to offer it to people with a very high income and a very low risk profile, because the banks now have to make sure they have a low risk tolerance, because they can't afford to lose out on all of their fees and all of their interest, because that's majority of their revenue, and that's what keep the banks going. So at the end of the day, let me know in the comments, would you rather have a lower interest rate or a stricter approval system? Because some of you might say, I want a lower interest rate, I have a high balance right now. And then on the other hand, someone that's building their credit, or they may be new to the country, which we'll talk about later on in the third point of this video, they may choose easier approvals because they're trying to establish themselves and build their credit profile. Because in most cases, you don't get to have the cake and eat it too, as they say. You have to pick one or the other because it's a nationwide balancing act. And if you thought that was a lot to go over and a lot to digest, that was just change number 1. We still have 2 more to go over, and the next one is a lot quieter, but in my opinion, it's a lot more powerful. Because right now, Congress is quietly considering allowing people to have things like rent, utility, and stuff that's not normally put on a credit profile unless you use a third-party service and pay for it, to be included on your credit report and score to ultimately help you push your credit score higher. And before you go crazy and start to freak out in the comments, this is not a mandated forceful action, meaning you don't have to opt into it. It's an opt-in only. So let's say that you want to build out your credit and you have a great rental history. It'll be able to take any positive rental payment history from the past or moving forward, depending on what they actually agree on, because again, it's right now it's being considered to help build out your credit profile, which is a big deal for majority of Americans. Think about it. Bills you already pay, rent, utilities, cell phone, internet, so on and so forth. We all have those crazy amount of monthly subscriptions could finally help you build out your credit score. If you are someone that's credit invisible, meaning they never had actual accounts on their profile because they pay everything in cash or they never established themselves, you're someone who has a thin credit profile, meaning only a few accounts, but not enough to actually establish some sort of context and a strong profile. If you're someone who is young and just starting out, if you're someone who is rebuilding and had some past mistakes, you should all be very excited for this change because this is going to help you in the future. But not so fast, because before, like we said, there's nothing free in this world and there's no free lunch. You can't have the cake and eat it too. There must be something a little bit deeper that we could discover. So my opinion right now is, well, if everyone's now reporting all of these things and they opt in for rent payments, so on and so forth, what if you don't have it? Is that going to look risky? If we have option A, Mr. Smith, who has a rent, a credit card, a internet bill, a phone bill, everything, and then we have over here Mr. Xander, and they only have a credit card, but they're not showing any rental history, they're not showing any phone bills, they're not showing any internet payments, electric, so on and so forth, are they going to be seen as inferior? I'm really curious to discover that once obviously more stuff comes out on this specific topic, but for now, let me know your thoughts. Do you think that will help, it will hurt, or are you going to completely just ignore this change? And before we go into the last part that I quite frankly can't even believe that is happening, I did want to say you don't need actual credit cards and you don't need certain accounts for people that say, hey, you need a car loan or you need a mortgage to establish yourself and build your credit. For years, I've been helping people fix their credit, build their credit, and strategize to get approved for houses, cars, business credit, so on and so forth, and every situation is different. Some people, they only have one thing on their report and a few other smaller accounts, and they also have an established profile. And then another person might just have a mortgage and one credit card, and they may also have an established profile. So it's not a one-size-fits-all. There's multiple ways to do it. So if you don't have a fully established profile or a certain amount of accounts, I don't want you to feel left out. That's the exact reason I share all these videos. So now's a good time if you're someone who's looking to build your credit. Make sure to subscribe to see a bunch of more videos like this that are completely free to set you on the right path. And to add to that, credit unions are a great tool to build your credit. I personally use one and have used one for quite some time, whether you get it from just being a public credit union, whether you get it from your employer, whether you get it from a family member. It's a great tool compared to a normal bank sometimes that offer less interest and a better approval odds because they technically work for you as a member versus just being a big bank that's incentivized to hit you over the head with a ton of fees. But change number one is by far the biggest change I have seen ever when it comes to credit and credit reporting, which is federal agencies have officially removed explicit guidelines that limit banks, credit unions, so on and so forth from factoring in certain citizenship requirements, immigration status, and things like that to ultimately get you approved and the size of your credit line. To be very clear, before you come for me in the comments, I'm not saying that discrimination is now legal. We do not support that here, and no one should support that anywhere. What I'm saying is the strict guidelines that they once had to follow have now been alleviated or completely removed, which may allow certain banks, certain credit unions to obviously practice in a different way. For example, a Visa card holder, a green card holder, a mixed status household, whether you have one of each, anyone without technically a permanent status, it may be used against them or at the very least may be used to evaluate risk. And this doesn't stop at new applications. This could be used for people with existing credit limits and existing loans. For example, let's say you have an American Express. I didn't choose them specifically, but let's say you have an American Express card and they now find out that you may not have a certain permanent status or a certain level of requirement that they now require for underwriting purposes, like a Visa card holder that doesn't have the right Visa card status. They may reduce your credit line or they may close your account indefinitely. At the end of the day, when rules shift, which is why I'm covering this video, there's a lot of gray that comes into play, meaning there's a lot of things that are up for interpretation. So until all of this plays out, we don't really have a perfect idea of what's going to happen, but all of this may definitely be a new normal. That said, the big picture, no matter if rules are changing, rules are staying the same, the people who end up winning are the people that know the credit game and the rules the best because they can play at a higher level of the game. Again, I think this is a lot to digest, but hopefully this video opened up your eyes and kind of made you rethink how the credit system works, what banks and lenders could actually consider when approving applications, credit lines, existing accounts, so on and so forth. So now's probably never been a better time to look at your specific credit report, your specific credit profile, and think about either restructuring or enhancing it to best prepare yourself for any future changes. And with that, I really hope you enjoyed this video and you consider becoming a subscriber to help you fix, build, and increase your credit score.